investors are grappling with a sell-off in global bonds as traders rethink the Fed's path for rate cuts. The U.S. 10-year yield touching its highest levels since July earlier today as the selling continues. Joining us now, we want to bring in Gargi Chaudhuri, Chief Investment and Portfolio Strategist at BlackRock Americas. And Gargi, it's great to have you back here on Yahoo Finance with us. Let's start with this move that we have seen in the bond market, because that's really the focus here this morning. We've seen a sell-off in bonds. We've seen the yields obviously move to the upside. I'm curious just your assessment of almost the shift in thinking and the narrative that we're seeing play out on Wall Street.
Sure thing. Good morning. It's great to be here. And thank you for having me once again. So absolutely the move, not just this morning, but over the course of the last month or so, in especially the long end of the bond market has certainly been something that investors have been focused on. And particularly what I tend to look at is how much of the move in 10-year nominal rates coming from real rates and then expectations of inflations, right? As what we're finding now is that, yes, real rates have certainly moved higher. So we've sort of moved up from that 160 level to about the 190 or so level. But at the same time, expectations of inflation or 10-year breakevens have also moved wider. So the backdrop here is an economy that, depending on whether you look at the labor market data, whether you look at retail sales data, you're seeing an economy that continues to surprise to the upside. If you look at that GDP, Atlanta Fed Now GDP forecast, that's continuing to move higher. And at the same time, your expectation of inflation remaining a little bit more sticky is something that probably the bond market's pricing in. We've long believed that investors should focus on the belly of the curve, so really keeping that duration around that 3 to 5 year part of the curve rather than the very long end, because as we point out in our investment directions for Q4, we still do expect that steepening to continue to take place.
So, Gargi, there's been a lot of talk about the Trump trade this week in relation to the bond sell-off that we've seen. Is it your view that any of this is tied to an idea of the market pricing in a Trump win?
I think, as I pointed out, I think we've seen a lot of good reasons that the bond markets have priced in recently. Part of that is the expectation of growth. That is certainly one of the drivers of especially the long end of the bond market. Higher growth is certainly going to always be commensurate with somewhat higher expectations of real rates, and that's exactly what we're seeing in the markets right now. I would also say that regardless of who's in the White House come 2025, one of the things that we've been talking about with our clients is just this expectation, unfortunately, of rising deficits. So deficits as a percentage of GDP is something that obviously we focus on, you focus on. And regardless of who's in the White House, that is something that's probably not going to come down. And again, that is something that the bond markets perhaps is sniffing out a little bit. And perhaps that's what is leading to some of this steepening and certainly some of the bear steepening that we've seen in recent days. But let's be clear, it's certainly also related to the expectation of better growth in the quarters to come that is in the price right now.
Gargi, I guess from an equity perspective, how should investors then be looking at this dramatic, I guess we can call it a dramatic move higher in yields? There have been some, maybe the more appropriate way to phrase this is there's been some more dramatic calls out just in terms of how high that 10-year yield could potentially climb between now and year end. I guess at what level does this become more of a challenge, more of a risk here for the equity market?
That's such an important question and absolutely the right one that we should be asking. If we can even think back to the beginning of this year and even the beginning of 2023, one of the most marvelous things that we saw in the equity markets was especially the quality parts of the equity markets, those companies that are symbolized by high earnings growth, very high levels of cash flow. We look at the ticker QUAL as a measure of quality. If you looked at those quality companies, they tended to do well despite a higher rate environment or a lower rate environment. Regardless of either, quality did well, tech did well. I think that if, obviously, barring a very sharp, steep move, significantly higher in rates, which I think can impact all equities, but I think a gradual move higher, again, and I underline this, for the right reasons, with the expectation of higher growth, can actually tend to be, or historically historically has tended to be good, again, for those earnings growers. So keeping quality at the core of your portfolio remains really important, we think. And then gravitating a little, especially now, I was listening to your program earlier, looking at earnings season, we think value can have its moment. We're focusing on large cap value in particular. BLCV is a ticker that we like that focuses on some of those areas, financials, healthcare, that are, we think, going to continue to have really strong earnings growth.